Welcome to the Demystifying Technology Podcast from the MacLaurin Group.
Typically, you go through the due diligence process. What the world of private equity is.
Can't wait. Demystify it.
MacLaurin Group was a proud gold sponsor at this year's ACG Richmond Capital Conference. While there, we hosted a series of short conversations with experts in the private equity space to discover their outlook and areas of excitement as they look toward the coming year. In this episode, Jim Headley sits down with Liza Bowersox of Venture First to discuss how she approaches valuation for a company to become transaction ready.
We are joined by Liza Bowersox from Venture First. Welcome.
Thank you. It's great to be here.
So, tell me a little bit about Venture First.
So Venture First is a financial advisory company that works primarily with private growth stage companies. And we work with primarily privately held businesses. Sometimes we work with publics that are approaching private capital markets for investments, but mostly growth stage private companies that need to deal with issues of valuation when it comes to approaching transactions, contemplating exit opportunities, or selling, giving away, granting away portions of their cap table to their employees and family members.
Wow, that's pretty broad. If you were to describe the magic that you bring and what your role is, how would you describe it?
The magic, well, that's great. I wish it were magic. I'm kind of bound to things that aren't so magical. But I think the magic and the thing that to me feels magical about this work is approaching private companies, in some cases that have never had an external investor or specialist come in and tell them what they're worth and be the voice of the market for those companies, to look at how they've performed, how they want to perform in the future, what assets make up that business, and put a number on it at a particular point in time. It's really challenging, but I think one of the things that feels magical for my clients is when they hold in their hands my valuation opinion that sums up their life's work, their family legacy, the things that they've created for their employees, and hopefully to enrich themselves over time, having not ever been exposed to the market in any other way.
So do they frequently approach you, or are you going out and approaching them?
It's most common for an attorney or a financial advisor or an accounting firm to refer us as a service provider for a specific valuation problem. A lot of times it's transaction driven, so they need to think about succession planning. They have a shareholder redemption event coming up, or they want to go ahead and grant out equity to employees as a form of compensation. Do a lot these days with families that are looking to, over time, gift out ownership of their companies to family members for an estate planning sort of project.
So you talk about the magic, and they get to sit there with that valuation and
right.
see that. I'm sure there are two sides to that equation, right? There's the magical ones.
Right, yeah. And I think that one of the things that I find it's very challenging in the work, but I enjoy doing, is being the first external person that's ever judged a company. And I get to tell them what's going well. And when I compare them to similar companies in the industry, really what I hope they take it as opportunities for them to improve upon their performance, to create future exit opportunities for the company, to understand how an investor would go about doing diligence in ways that they can kind of level up in their operations to make them transaction ready. In some cases, that's something that they're interested in. In some cases, they just prefer to go along as they're getting along. But for me, I feel like I'm adding value when I can not only critique a company, but point out opportunities that they can create success in the future.
If you were to write a book, what would you title it, and what would it be about?
That's funny. That's a running topic of conversation at Venture First, because I delight in serving all kinds of different industries. So I think the last we had the discussion, it was Lamborghinis, adult novelties, and burlap sacks by Liza Bowersox, because I've valued companies in all of those industries. I've done 47th Street diamond wholesaler in Manhattan and those sort of businesses. No one ever gets to look at those. So it makes me kind of popular at dinner parties. I have a lot of great war stories, and I've worked with some really colorful entrepreneurs and really colorful companies. And to me, and the passion that I bring to this work is my admiration for those that approach the entrepreneurial journey, that step into that arena, that bring an idea to market, and to see those companies develop through the growth cycle of a company. It's just thrilling. And I'm supposed to be very impartial and kind of not, certainly not vested in what's going on with my clients. But every time I get to do an update report and I see that a company has raised a new round at a really impressive valuation, or is approaching, that liquidity event that they've worked for 6, 7, 8 years for, it's thrilling. And I just am so happy when I get to see companies fulfilling the American dream.
Well, and it's an incredibly personal moment when you sit down and given that diversity, right? You have to be all things to each owner. You have to present that air of expertise in that valuation process. And because it's so personal, how do you approach that when you're talking about diamonds and burlap sacks?
Right. Yeah. So I think it starts with a lot of research, and we invest heavily actually in some of the ACG vendor partners. We use their products to make sure that we do have our head around this industry and we do understand the competitive landscape. There's a vendor downstairs pitch book that does a great job, I think better than many other data sources, about representing the companies that are out raising capital in the private markets, what sorts of valuations are coming in, what sorts of investors are forming syndicates around those companies. So I think market intelligence is the biggest challenge, making sure that for the vast majority of American companies that are not being reported on publicly, how you get that information. And I think for me, I come from a liberal arts education background. It's the thrill of the research and the hunt and pursuing the best information that I can bring into the conversation. And from that, there's a lot of art to it. And I think understanding not only what the classic academic valuation methods suggest a company should bring in a market transaction, but realistically among their peers, is there that market at that valuation?
So I know there's probably as diverse as your client base, there's probably as broad a spectrum of at what point these organizations are reaching out to you for this valuation. When do they typically reach out? At what point in their process are they reaching out? Do you feel it's too late? If you were to give them that one piece of advice as to when they should be engaging you, what would that be?
Right. I think for the most part, we receive referrals when a company has completed its first, let's just say, institutional capital raise, or when there is a desire for external scrutiny on the valuation of a company. So honestly, it comes down to at what point are they forced to do it for regulatory compliance reasons, investor information rights, or what's really neat that we get to do is when there's mergers and acquisitions, we can look at the balance sheet of the company being acquired and figure out how to divide up the assets that you can identify on the buyer's balance sheet. But because a lot of times they come to us at a transaction event, we really don't have the opportunity to influence decisions made around valuation issues that happen earlier in a company's life. And I think a lot of times it's problematic when, let's just say, for example, we see a company that's raised primarily through friends and family investments, and they convince their grandmother to invest in their company at a $20 million valuation. And grandma does that because she's just super excited about the whole thing. Sure, grandma's the best. You want grandma on your cap table. But the thing is, if it comes down to it and the second round comes in at a $5 million valuation, grandma's getting diluted. And if it's not your grandma, that can be a very disappointing conversation to have with earlier investors that maybe weren't familiar with typical venture capital terms and what kind of protections they should have laid down when potential future dilutive financings could happen. So I think even if it's a conversation, and at Venture First, we're really friendly to having just a casual conversation about if you're going to self-value, here's some general guidelines that you should think about, and perhaps a little bit of research and diligence you should do to just not set yourself up for surprises in the future.
Yeah, no, that's not surprising. As we've worked with organizations who would come up with valuation, we have run into that before where maybe we didn't understand the value or perceive the value, but if you're an early investor, that can be really disappointing in this process. process.
Right.
Those are rough waters to navigate, I'm sure.
Yeah, I think another thing when it comes time for a company, a lot of times they're working with us not only at their first external valuation, but at their first audit. And that, I think that engaging the right expertise, whether it's internal or bringing in some vendor support, some third-party accounting expertise, just to kind of keep the hair off the dog as you move through. I think I've heard the first audit process has been compared to a colonoscopy. It can be extremely painful for all people involved, but at some point it's necessary. So beginning with the end in mind and knowing that external scrutiny is a reality that you should, from day one, think about and make sure you're setting yourself up for the least disruptive operations going forward when those kind of more formal operating procedures start to become required.
So, we talked about the diversity in your clientele. Is there any area where VentureFirst typically defines as their sweet spot, the industry that they would have the most exposure to?
Yeah, so I think it's driven by what's being funded. So the lion's share of our clients are in the healthcare, either health technology or actual life science. We do a lot in biopharma, and then also technology companies, just broadly, I guess, software as a service. We work with a lot of companies in that realm. And internationally, we serve a lot of really interesting companies in Asia that are doing work with payment processing and mobile communication technologies. And I think it's interesting to see in the United States, we take a lot of things for granted, and the maturity of our commerce here, the ability to easily and securely buy and sell things from trusted parties, you can't take that for granted abroad. And so much of the global population isn't actually here in the States. We just see a lot of investors attracted to looking at markets abroad in ways that they can achieve some pretty high rates of return on those investments.
Well, and those are some fairly highly regulated industries within the U.S.
In the United States, they are, yeah.
Well, but I would assume there's also the regulatory concerns, and not just domestically, but internationally. While it may not be as heavily regulated, you have to become somewhat a jack of all trades and able to navigate that as well.
Right. I think, boots on the ground and local counsel in terms of evaluating risk. If we're working with a couple companies doing things down in Brazil, and just the currency risk down there. If you're going to do an investment in an agricultural company in Brazil, you best be really clear about how to handle the risk of the company. The government just putting your company out of business or taking back the assets at whim.
And eliminating ethanol from their fuel.
Pretty much, yeah. Yeah.
So I'd like to step back to the valuation process where you've done your magic. You've put this valuation for the first time. It's an outside opinion of what that organization's value is. There are those moments when they're standing there with that piece of paper thinking, wow, this was way under what I would have expected. How do you circumnavigate that topic, and what are the avenues for essentially rectification for the client?
Right. Yeah. Well, it's interesting, especially when you're working in the earlier stage company population. I think we always start the process with full independence. And the first time a client sees a conclusion from us is when they receive a draft report. And we do, not all the time, but very frequently get pushback and a client being very surprised. Depending on the purpose that they've hired us for, I'd say in, let's just call it venture capital-backed company world, a lot of times these days, they're surprised at how high the valuation is. And I think that one thing that is a little bit interesting is when you see a VC come in and put a really strong valuation on a company, and you have to think, well, how does that reconcile with how other VCs would put a value on a company? How does that reconcile with what the ultimate, let's just say, auditor or regulatory body, mainly the IRS or FASB, SEC, like how would they view it? And also recognize that it's a point in time estimate. And I think we're sitting here in the second week in October, first week in October. There have been some fascinating things happening in the IPO market where you've seen the value of WeWork come down threefold. And you think about fundamentally, what are the assets of this company? What is an investor ascribing value to? In early stage, a lot of times it's the strength and the quality of the management team. I've had a case where a client tells me, Liza, I need you to do a valuation. And I said, great, you're off to a new venture. They said, well, I'm thinking about it. But I was sitting down with someone just mentioning I'm thinking about starting another company. And they said, here's a term sheet. Here's your first $20 million. Have at it. And at that point, they don't even have any idea. They don't have any operating plan. They don't have any technology, assets, none of it. But their skill as a serial entrepreneur and the investor confidence and their ability to execute, that's the asset right there. And I think that's the difference you see in companies that are going out for their first round and are a fairly unproven management team versus those that have a fantastic track record. You can see like massively different valuation issues that come with that. So it's one of the things that we have to reckon with and figure out, what's the intangible here that an investor sees that might be perhaps a little bit early, perhaps a little overly enthusiastic.
Yeah, and it looks like the market is adjusting more towards, all right, well, now let's talk about the revenue, right?
Well, yeah, I think it's, I'm frankly, I'm glad to see it. And I think that at the end of the day, valuations, the present value of future cash flows. At some point in time, the cash has to flow, and you have to have some kind of rational business model that shows at what point that happens. And the investor then figures out what the risk-adjusted cost of capital is to achieve that.
Yeah, when I think back to the dot-com bubble many decades ago, it's not nearly as severe as that, but I think people are hearkening back to that lesson in life. Those extraordinary valuations that were placed on technology firms as the internet, as the interweb was brand new to the world.
Well, I think valuation in terms of private companies that are out there raising money from the VCs, in many cases, it's not a real number. You have to look at the terms. You have to understand a lot of details that often aren't in the press releases. And I think more than anything, the investors view it, and the ones that I've spoken to at least, as a tool to manage dilution. They want to put down a certain amount of money. They want to buy a certain percentage of a cap table. And the valuation is just a product of those two factors. It's not necessarily that they believe in that top line number, that press release number that goes out there.
Well, Liza, thank you so much for joining us today. I have learned a lot. The valuation process is an area I find somewhat intimidating. I do enjoy that research aspect of it, but I really appreciate you.
Let's just be clear. It's not altogether magic. There are...
Oh, no. I disagree.
There's art to it, but we try to, at Venture First, at least bring all the science and all the academic literature, all the historical market information that we could find to bear in our opinions.
Absolutely. Well, thank you.
My pleasure. This has been fun.